Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Today we have a very special guest joining us. Everyone, please welcome Wealthion founder Adam Taggart. Adam, thanks for joining us.
It's a pleasure to be here. Great to see you, Ivan, and great to see you too, Jim.
Thank you for joining us. The one of the key things that is going on in the market this week that I wanted to get you on to talk about is the Fed minutes. It's really a lot of people were surprised. I know something you've been on talking about recently is the market's been anticipating a pivot. And based on the Fed minutes that came out this week, that's not really in the cards right now. So how are you interpreting this right now for the Fed's policy going forward? And ultimately our audience wants to know what's the outlook for gold and silver in relation to this?
All right, so I'll get to the end answer about gold and silver, and believe it or not, I will have a positive outlook for the precious metals. But we're gonna take a path through there, sort of through.
Yeah. Let's talk this out. Let's figure it out, Adam.
Yeah. There's a lot of important cogs in
let's
here.
Unpack this.
Great. Well, first off, I was not surprised by the Fed meetings today. I do think the market is going to be continually surprised by the Fed's behavior going forward from here, because, as you said, the market's been on a tear for the past month, and I think it's largely been doing so in anticipation of a Fed pivot, or at least pause, in the relatively near term. And for a while now, I've been talking about, with a lot of the experts that have been on my channel at Wealthion, is the fact that I think the Fed is going to be hiking higher for longer than most people, and certainly the market seems to expect. If you look at the Fed's dot plot, and what the Fed is saying in terms about how much it plans to still hike here, it's very different actually from the remaining rate hikes and then future rate cuts that the market itself is pricing in. Basically, the market's been calling the Fed's bluff, and they've been playing a game of chicken here. But here's the reason why I don't think the Fed's going to be able to, or is going to choose to pivot anytime soon, which is, the Fed, it's not a super competent institution, as we've railed about in the past, but they're not complete idiots, and they realize that they have boxed themselves into a corner where they had blown the biggest asset bubble in history, the everything bubble that everybody's talking about. And they brought interest rates down to zero, and really gave themselves no room to maneuver when the next economic down cycle arrived. And so they realized that they were very vulnerable with that. Inflation has given them the excuse, even though it's been by force, Fed hasn't had any other choice, but to start hiking rates again. So the Fed obviously has to hike rates to try to bring inflation under control, but it actually wants to get rates higher so that when the next recession arrives, at least in full force, they'll have room to bring rates down again and try to goose the economy a bit. So the Fed is basically a dual mandate, right? One is to keep inflation low, price stability, and inflation is raging at, still 40+ year highs right now. So it's got a massive inflation problem. It's got a lot of immediate pressure to keep hiking rates, to keep inflation under control. It also has an employment mandate. Well, if you look at the recent payrolls report that came out, that honestly I think is really suspect, but it doesn't matter because that's the report the Fed looks at. It says that jobs are still going gangbusters, and the unemployment rate is still down near record lows. So by the measurements the Fed is using, it's got all the runway ahead of it that it needs to keep on raising hiking rates from here. And as I said, it wants to get rates as high as it can before the next crisis, so that it has sort of maximum room to maneuver. I think the market is going to, sadly, it's been partying on because it thought that because inflation dipped, wow, inflation went down month over month from June to July. Yeah, it went from 9.1 to 8.5. I mean, that's not a big drop, and it's still at a ridiculous high, right?
Right.
Didn't Biden say inflation's at 0% though?
Zero.
No.
Yeah, he did.
Yeah, and I want to say it was inelegantly put. I think what he meant to say is we had flat month over month inflation, which is why the CPI started to come down. But that was definitely foot and mouth moment there for a guy that
it
seems to
seems
have
like
a lot
all
of
the
those.
politicians really wanted people to believe that, though, that inflation was 0% last month. Yeah.
Well, and look, that plus the whole, hey, let's redefine what recession really is, because we're
Right.
not really in a recession because we're sort of changing the definition in real time here, right? I mean, this is sort of classic what all governments do when they have bad news that they want to spin into good news, right? And this is, the party that's most vulnerable in the upcoming midterm elections in November is the Democratic Party. And so they don't have a lot of strength to run on right now. And so they're just desperately trying to, massage voter opinion before people actually go into the voting booths. I actually think this is going to backfire on them,
Right.
because look, inflation may continue to go down from here. In fact, I expect it to over the rest of the year, but I don't think it's going to go down at a fast pace. I think it's going to, be gradual declines, and I wouldn't be surprised if we see a few uptick months and whatnot. And so it doesn't matter how much you try to tell people that everything's fine, how much you try to tell them that inflation's under control, how much you try to tell them that no, we're not in a recession. It really doesn't matter what you call it. What matters is how people feel, and people are increasingly feeling pinched, pressured, and hanging on in many cases just by their fingernails. And if I can, I've got some data here, just to kind of go through on sort of what the general consumer is experiencing here.
Mhm.
So first off, just in terms of how the economy is doing, right? No matter what the politicians are trying to tell us or what the media headlines are trying to tell us, it's not doing very well, right? We've had 2 quarters of contraction, right? Which in the old world was the technical definition of recession. Whatever you want to call it, it still ain't good, right? And that's just not just the US only. This is happening globally. So we have to really understand that the world is in the same sort of bad state that the rest of us are in. Some places even worse, like Europe. But the IMF just published its World Economic Growth forecasts, and it's showing, and this is the IMF's own words, that the global economy is stalling. So it had a 6.1% growth in 2021 and last year. This year, they've just downgraded it to only 3.2% growth. So that's almost cut in half. Next year, they're planning it to be even lower at 2.9%. And so they're saying all the factors we're talking about here, inflation, the lockdown in China, the second largest economy in the world, and then all the trade war disruptions that the war in Ukraine is creating, as well as the energy crisis that's going on worldwide, but particularly there in Europe. Total unemployment claims, even though that recent payroll report said, hey, there's nothing to worry about here, initial unemployment claims are up from the bottom they hit in March by 63%. So we are beginning to see that more and more people are beginning to get laid off. And, I just did a quick Google search on layoffs right before coming on here. And if you don't mind, I've got a list I'm just going to bang through.
Go for it. Go ahead.
All right. So Peloton, they just laid off over 4,000 workers. Shopify laid over 1,000. 7-Eleven laid off almost 1,000 management positions. Vimeo laid off 6% of their workforce. Tesla has announced it's laying off 10% of their workforce. Rivian, another car company, is laying off 5%. Ford is laying off 8,000 workers. JP Morgan just let go 1,000 people in their home lending department. Remax, the realty company, is laying off 17%. Compass, another one, is laying off 10%. Wells Fargo is laying off an undisclosed number of people. Redfin, another real estate company, laying off 6%. Coinbase laying off 18%. Carvana, 2,500 positions. Better.com, 5,000. I'm almost done. Robinhood, 9%. Netflix and PayPal are also laying off people. So guys, look, this is not, a random layoff here or there. These are some of the larger companies in America laying off substantial numbers of people. And one company, big one, Amazon, they just announced that in the second quarter of this year, right, that just ended, they let go 100,000 workers.
Wow.
Just a single company alone, right? So, we've been sort of seeing companies announce hiring freezes and whatnot, and people have been saying, yeah, the storm's going to get here when you start seeing layoffs. Folks, we're already beginning to start seeing an awful lot of layoffs from a lot of companies, and this is just companies that have announced in the past couple of weeks here that I did pulled off the Google 5 minutes before getting on with you. There's a lot more going on there. So the point here is that the economy is not doing well, and probably you can make a pretty good argument, going to be doing even worse going forward.
Yeah.
So
I just tweeted this morning. Recession, what recession? Target's profit. You know, if there's ever an indicator for the consumer economy, I would say it's, you know, Target, Walmart, those types of huge retailers, and profit plunges 90%.
That's crazy.
90%. Yeah.
Yeah.
So this is not academic, guys, of somebody crying wolf and saying, hey, you know, I see some doom and gloom in the future. This is all real-time data that we see coming in. And I won't go into too much detail here, but the other aspect too is, you know, sure, when the stock markets, you know, they got hit hard this year, they've regained about 50% of their loss. They might roll over from here, who knows? But while that's an important indicator in terms of, you know, people's attitudes and the wealth effect, it's not nearly as important as the housing market, because something like 90% of all financial assets are owned by the top 10% of households. They're not that widely owned, you know, across American society. But 2/3 of home, you know, people that live in a home own their home, right? So what happens to housing prices impacts way more people and impacts the spending of way more people. And all the indicators that we're looking at is that the housing market, which has been on fire for the past 12 years, and had an amazing year last year, right, up 20% in most cases, in most markets, in a single year, is now finally rolling over. And there's a lot of really worrisome signs there. And I pulled a bunch of data. I probably won't go through it all here, but just a couple quick things. We're seeing a record spike in home buyers who are backing out of deals, right? People that bought a home, it was being constructed, and now that it's getting ready for them to move in, they're saying, you know, I want out of this deal now,
right?
Because mortgages are now so much more expensive. The supply of homes for sale across the U.S. grew at 31% year over year last month. That's a record high rate. So basically, inventory is starting to explode, right? And here's one quick anecdote. So I don't know anything about this house. I just know it was listed in the story by Bloomberg. This house was put on the market earlier this year, I think back in like February, at 9.5 million, which sadly, guys, is not a crazy home price for the city of San Francisco. It didn't sell. They dropped the price in April, I believe, down to 7 million. Didn't sell. In July, the house went up for auction at 4.5 million.
Jeez.
Down from 9.5 million.
That's crazy.
And it got no bids at the auction. No buyers at that dramatically reduced price.
Is part of that mortgages are more difficult to obtain right now, or, you know, jumbo mortgages, these, or any of that? I mean, I've heard a little bit of information, not that I haven't done any study on this, but that mortgages are getting a little bit tighter on the restrictions. Is that part of this?
That's probably true. But I suspect what's going on here is that mortgages are just getting a lot more expensive, right? I mean, they're up roughly double in the past year.
5% versus 3% right now.
Yeah. And in the San Francisco market, even if jumbo mortgages are getting a little bit harder to get by, there's still a ton of people there that can pull out their wallets and pay cash for a $9 million home. But I think people are just balking now at the price, given where the price direction is headed. So here's just the key part I wanted to end on, which is it's a recent quote by Robert Shiller, you know, founder of the Case-Shiller Housing Index. This guy was all over, you know, the media back in the 2007 housing bust, because he had largely been warning about it, given the Case-Shiller Index that he put together. So here's what Robert Shiller had to say. He said, home prices haven't fallen since the 2007-2009 recession. Right now, things look almost as bad. Existing home sales are down, permits are down, a lot of signs that we'll see something. It may not be catastrophic, but it's time to consider that.
Yeah.
So when Robert Shiller starts comparing today's housing market to what he saw back in 2007, we really better be paying attention. And for him to even sort of suggest the word catastrophic, I know he's not a hyperbolic guy.
That's very interesting. So give us some good news. How does this play into gold and silver? What our audience cares about? You know, you said you had a happy ending to the story. So.
I do. And I'm going to go through one more sort of valley of despair to answer that question.
The valley before the end of the rainbow. All right.
There we go.
Exactly. The hero's journey. He always has to face the villain right before.
You got to have our trials and tribulations before we get there. Okay.
Exactly. So let's go back to the Fed here, right? So The Fed is actively still trying to decrease demand, right, by these interest rate hikes. As I just mentioned earlier, looks like it's going to continue hiking rates, and I think they're going to. People have said the Fed is going to hike until it breaks something, and I think that that's probably relatively accurate, where it's going to get as many rate hikes as it can under its belt before it's forced to pivot by some sort of external event. Now, there's a delay, there's a time delay between when the Fed pulls a lever and when the impact of that is felt in the general economy. And it's measured usually in quarters, and I'm averaging, but it's roughly around 9 months or so. So the Fed started hiking the Fed funds rate up from 0 back in February of this year. So we're not even at the 9-month anniversary of that yet.
Right.
So all the things that we're currently seeing right now, to a certain extent, aren't really taking into account all the hikes that have been done between February and now. And now that we're up at a 2.25 or 2.5 federal funds rate, that is the fastest pace at which the Fed has ever hiked the Fed funds rate in history.
I've seen those graphs, yeah.
Yeah, and so this is where understanding rate of change becomes really important, right? So imagine if I gave you a gallon of water to drink, Jim, and I gave you a week to drink it. You'd have no problem, right? But if I just shoved it up against your face and made you chug it all at once, you drown, right? And that's why rate of change is important. And the Fed may be engineering sort of a similar economic waterboarding of the economy right now.
Economic waterboarding.
Economic water, yeah.
That's a fabulous analogy.
Thank you. But where the economy is not going to show the impact of that, until this delayed effect comes into play, right? So what very likely is going to happen is that because of inflation and organic demand destruction from that, because of demand destruction from these rate hikes and all the other exogenous, supply chain issues and stuff like that, driving down economic growth, we're highly likely to slid further into recession as time goes on here. But then we're likely to start getting impacted by these delayed repercussions of what the Fed has been doing, right? It's almost going to kind of be like a multi-car pileup on the highway in the fog, right? Where just the cars can't see the wreckage ahead. And so new cars just keep slamming into this thing one after another, right? So things could get pretty bad economically, financially. That very well may be what finally breaks the euphoria in the markets, proves that what we're in right now is likely a bear market rally that then goes to new lows, and where the bottom is, who knows, right? So here's where things get rosier for the precious metals owners.
Thank God. Thank God.
Thank God. And there's sort of two twin benefits, I think, here. One is, like I said, I don't think inflation is going to come down quickly for a variety of reasons. And I think as the market wakes up to the fact that the Fed is not pivoting anytime soon, and that euphoria burns off, the markets are going to start correcting again, and investors are going to say, you know what, I was hoping against hope that inflation was taken care of here, but it looks like it's not, and I got to start taking some of the capital I have remaining here and getting that into some sort of inflation protected asset, right? And I think that's going to bode very well for the precious metals. At the same time, when the economy really starts faltering here, and we have that economic, car pileup I mentioned here, that's when I think the crisis trade is going to start coming back into play. And that's where capital is going to be seeking safe haven. And yeah, a bunch of it will probably still go back into the long-dated US treasuries. But I think a good chunk of that too is going to go back into the precious metals. And that may be that economic, crisis, that very well may be what forces the Fed back to pivoting. And even the announcement of a Fed pivot is going to be very bullish for precious metals, because obviously that's where real yields are going to continue to get more negative on a going forward basis. So while I think there's a lot of pain for a lot of people to endure ahead, I think those that positioned in advance in precious metals are going to probably end up doing quite well, and probably, I think, outperform on a pretty substantial basis near the tail end of this. So anyways, that's my good news, quote unquote, good news for those folks.
Adam, you are the master of financial analogies.
Yes.
Financial investment analogies. This is so entertaining to hear you, put this in real man's, common language that people can really understand. And I think that's why Wealthion's been so successful, your YouTube channel, just because you're a great explainer of how things are going on. And I appreciate you I appreciate you coming on our channel and providing your input on the current outlook. We really want to thank you.
Oh, it's always a pleasure, and praise like that means a lot to me because I look to you guys as being particularly good explainers. Again, sort of for the everyday man, the guy who's just trying to understand what's going on here. You guys aren't big jargon guys. You take complicated issues and you distill it down in a way that every investor can understand. So,
Ivan and I, we like to say we're a couple of amateur hacks who have a YouTube channel.
That's right.
We make no claim. We make zero pretentious claims to be experts on anything.
Yeah.
We're just a couple of amateur hacks who like to talk and bring guys like you on our channel. So thank you very much. We appreciate it.
it's a complete pleasure, guys. I'll come on anytime you'll have me.